let's dive right in. The first thing, just to warm this up, numbers are the language of business. So you want to get comfortable with at least some basic math. We're not going to get very complicated tonight, but a lot of time when I talk to entrepreneurs, they're afraid of numbers, and most of what you need to do, you can do with basic math. So don't be afraid of it, embrace it. And so when people talk about valuation, what they're really talking about is pre-money valuation, and I'll explain what that means. It's basically the amount that your company is worth. And so there's a pretty simple equation. Your pre-money valuation, which is what people talk about with valuation, plus the cash you raised is your post-money valuation. And to put some numbers into that, sometimes when I hit, okay. So if you're saying your company's worth $200,000 now, and you're raising $100,000, at the end of that, it's 200,000 plus 100,000 is 300,000 post-money. And what we're talking about when we say valuation is really this pre-money, and then you go out and raise the money, end up with the post-money valuation. Oh, I guess this is the mouse. That's the problem. All right. And so if you do this deal, the investors who put in that $100,000, they own whatever they invested divided by the post-money valuation. And this is more or less the most complicated math we'll do all day here. And so we're talking about the cash invested divided by the post-money valuation. So they own a third of your company if you do that deal. So it's important to understand how this works, and we'll go through a couple different ways to look at this. And so again, we're talking about this piece here, which is this pre-money valuation. And there's lots of valuation, lots of methods to get there. And John, where are you? Here? Oh, there. Yeah, okay, great. John has spent all week mapping out a bunch of different methods. I'm gonna show you some easier ones, but we'll start with, and again, get comfortable with basic math. So this one, and there's some different versions of this, is basically you give people credit for having accomplished certain things and taken certain risk out of the deal. So the way this one works, there's just five categories. So it's the idea, the technical risk, the execution risk, the market risk, and the production risk. And basically you can rank people on a scale of 1 to 5. And if it's a 1, you subtract $500,000. If it's a 2, you subtract $250,000. If it's a 0, it's 0. If it's 3, you add 250. And if it's 4, sorry, yeah, I need 5. 1, 2, 3, 4, 5. Yeah, if it's 5, it's add $500,000. And so for each of these categories, you can make an assessment, and then you end up with the total down here. And these numbers in this total, and we'll talk about this in a second, should really be based on the market you're in. It's kind of like buying a house. You're in a market, and companies in general have a certain value in the market you're in the industry you're in, and the stage you're in. So this kind of changes based on where you're at. And then some people get fancy with this and they'll weight these different things. So they'll say the team is actually more important than the production. And so they'll weight this higher in the second category. I promise to keep the math easy, so I'm not going to dive too deep into that. But it's a very simple idea. Just look at a couple different categories, rank them, and use that to adjust the valuation based on whatever you're seeing in the market. Keep hitting the mouse button. Okay. And so another way to look at it, and this is interesting because you're looking at it from an investor perspective, and I think this is a piece that when entrepreneurs are raising money, they're not really looking at it through the investor's eyes. They're looking at it through their own eyes, which is, I want the money. What the investors want is they want the exit. So they want to know that you're going to get out at the end of this for a certain multiple over what they put in. So in this case, if I'm an investor, I want to get out. I want the company to exit at a $100 million valuation. The big M means million in this presentation. And I want that to be 20 times what the valuation was when I invested. And entrepreneurs or investors are typically looking for 10 to 20 times their money back out within 5 to 7 years. And so if we do the math backwards and we take the exit divided by the target ROI, our post-money valuation is 5 million. And from there, we can start to calculate backwards. So if my post-money is 5 million and I'm putting $1 million into it, that implies that the pre-money valuation, which is what we're solving for, is 4 million. But there may be another round of funding or something may happen, so we can take that one step further and take that 4 million and say, well, I might actually get diluted because some other investors come in. So I'm going to assume that I'll lose like 30% of my investment will get diluted. So I'm going to back out to 2.8 million as the pre-money. So that's one way that investors think about this, which is very different than the way you're thinking about this. And I want to thank John again for he's helping put together these last couple slides. And he's actually the expert on the room and in the room on startup valuations this week because he's researched more methods than any of the rest of us. Okay. So he also came up with a list, and I've seen some of these, I've used some of these, of a lot of different methods. There's discounted cash flow, First Chicago, risk factor summation, Black-Scholes. Some of these actually come from public traded companies like stock investing or options trading. The thing is, for the ones that come from that, they're expecting to have real cash. So you can predict what the cash flows are going to be. With startups, you usually can't predict what the cash flows are going to be. So it kind of falls apart. There are ways to do it, but you're basically making stuff up. I also recommend in doing this, we came across this site, Equidam. You give them your email and fill out a bunch of questions and they'll do a complicated valuation for you. So again, keeping the math simple, you can use them. I have no affiliation. It was just, they had a really nice way of setting it up. And they do, as part of their format, they look at your industry, they look at your market, and they do some weighting appropriately for you based on what's happening in your specific market and industry. And so with that as the background, we're going to move away from the complicated valuations, and I'll just walk you through a few tips here. So the first thing is maximizing your valuation can minimize your chances of success. A lot of people get very caught up in what's the company's worth, and they get offended if they don't have a big valuation. But really, that can hurt you. The main goal is to take a reasonable deal and get into motion building your business. That's where you really win. And so, as I've mentioned, you're in a marketplace, and so there is kind of a reasonable range, and you're not going to be able to do much better than that reasonable range in the industry you're in the stage you're at. People prove me wrong all the time, but it's kind of like if you were selling your house, you wouldn't be able to sell your house for 10 times the value that your neighbor could sell their house. So you have to kind of be realistic within the market. And as a rough rule of thumb, try not to give up more than 25% per round. I broke that rule with SlideRocket when we raised money. We gave away, well, we sold to investors 28.5%, but it all worked out. So again, it's a rough rule of thumb. But I have seen some people get into trouble where, like with the first investor, they give away 50% of the company, and then it just gets harder down the line because there's not quite enough equity to work with. And then what you really want to do, and we'll talk about this, there's kind of a ladder you want to be climbing, and there's a couple stages on that ladder. And you want to go through the process. So you want to go through the ladder, and I'll spell this out for you in a second. But you want to achieve at least 3 times growth in your valuation at every step in the ladder. And I'll lay the ladder out for you in a second. But that's actually more important to show that progress than it is to get the best valuation, especially in the early round. All right, so part 2 is to decide how much money you actually need. And you want to work backwards. What do you need to get to the next round, which is essentially the next step on the ladder, the next rung on the ladder? And so we talked about this equation: pre-money valuation of 200K, cash invested 100K, post-money valuation of 300K, simple addition. So how do we get to that 100K or whatever the number was? In the case of SlideRocket, we raised 2 million. That was our first round. And we did it. We had a bunch of traction. We had a bunch of users on a wait list. We had a working product. And we raised 2 million, and I'll talk about how we got to that number, but we created some financial projections, and I'll go through that in a second. And so we've laid out some rough brackets here. So if you're at the idea stage, in today's world, you may need $0, because you may have a day job, you may be able to fund it yourself, you may be able to do some tests online, you may find a friend who can build the first version for you. But you may also be able to raise a little bit of money from friends, family. But if it's the idea stage, you're probably raising from people you know and not strangers. In your second round, which is a seed, and here you might have some kind of prototype, but you don't really have a working business yet. And again, this is rough. So you might raise 1 to 500K from angels. And then the third, let's say you have some traction, and this is kind of where we were. A rough rule of thumb is $15,000 per person per month for 18 months to give you that kind of runway. So backing out what we raised, our $2 million, if you do the math, was 7.5 people for 18 months, which is kind of what we did with the money when we got it. And that 15K is not what you're paying in salaries. That 15K is whatever you're paying that person plus overhead. Like there's a lot of extra buffer built in to pay for computers and marketing and problems and all that kind of stuff. It's just really a rough rule of thumb. And then when you do your real Series A, that's when you have a functioning business. And really what you're buying with that $2 million is growth. Like you're going to put a lot of that into marketing and whatever you need to do the product to add more customers. So you have a working engine and you're just buying a bunch of gasoline to put in the engine. And so this is the ladder I'm talking about. So a lot of the times what we see people do is they show up at this stage, but they're trying to raise with this in mind. And that doesn't really work because you can't do this at the idea stage unless you are an incredible salesperson or know some really rich people. Both of which are true. Like I said, people prove me wrong all the time. But this is kind of the ladder, and this is the way to think about it. And really, you want to be 3xing your pre-money valuation at every stage on this ladder. Okay. And the other thing to keep your eye on, we talked about how investors want 10 to 20, especially at the early stages, they want to see significant multiples of what they put in within a certain time frame. So when you're taking money, you're getting onto a treadmill that is supposed to deliver an exit to investors, either through an acquisition, you get acquired, or you IPO. And so, so with our deal, we raised $2 million in cash on a $5 million pre-money valuation. So when we took the $5 million pre plus the $2 million cash, we had $7 million that our company was worth post-money. And so the investors are expecting it to sell for $70 million within 5 years. And so the math gets scary quickly because if you have a 20 million post-money valuation, especially if you're Series A or earlier, your investors, if they want 10 to 20 times that, now you got to sell your company for 200 million to 400 million. TechCrunch says the average company sells for 150 million. So the further you go beyond that, the fewer companies are available who can acquire you. And you can make a lot of money selling companies for $50 million and find a lot more buyers. So just keep that in mind. There's a couple different ways to raise money. Equity is giving investors, setting a price and selling a chunk of your company to investors. The convertible note allows you to avoid that, and there's something called a SAFE. And basically, it's a loan. All right, and there's something called a cap. I'll explain that in a second. So the convertible note terms, because it's a loan, it has a term. So you may be doing this for 2 years, after which it will convert to equity. The SAFE was invented to not have a timeline. It was invented by Y Combinator. So it'll never convert based on time. These things are designed to convert when you raise your next round. You're saying, I don't want to price the round right now. I want to wait till the next investors come in, then we'll price it, and then we'll give you an interest rate for the length that you, Mr. Investor or Mrs. Investor, I'll give you an interest rate for the length of time it takes for that to happen. And then I'll give you a discount. So when the next round comes in and buys shares, I'll cut you a discount versus what they're paying to compensate you for the risk you took in investing in me. Or we'll set a cap. And the trick with the cap is it's basically a price. So regardless of how well you do, you'll never convert at less than or more than a $3 million valuation. I'm not going to get too deep into the math here, but it's essentially a price you're saying. But if you look at it from the investor's perspective, if I give you $100,000, invest $100,000 into your company, and then you go out and crush it, and all of a sudden your company's worth $100 million, my $100,000 is worth nothing compared to the $100 million. So I've actually missed out on your success that I helped make happen because I gave you the money. So the cap is a way to try to keep that from happening. So if it goes to 100 million, I still converted a $3 million valuation, and my $100,000 of that 3 million is a much larger percentage than my $100,000 of 100 million. So it's just solving for that problem. We're already too deep in the math, so I'm going to pull back out. So of course you want to know what are the market rates, right? And so when you're dealing with investors who really invest all the time, they are seeing deals and they know sort of in their heads sort of what range of price you're in, and they know what the deal terms are for your specific deals. So the shortcut, since you're not an investor, one, talk to your investor friends, and two, get a good lawyer who does startups, because your lawyer is seeing these deals all the time, and your lawyer can tell you what the market rates are and what the standard deal terms are for the market. And so if we come back to the convertible note terms, this is one I was looking at the other day that was done by a lawyer. 24 months. The interest rate was 5% because we're in a low interest rate environment. Back when we were raising money for SlideRocket, we were talking about doing a convertible note at 8 to 10%. And that's an annual rate. The discount, so if someone comes in and invests in a future round and prices the company, I buy shares with my initial investment plus whatever interest is accrued at a 20% discount versus those next investors. Or, and this part just depends, you negotiate this, but the cap might be 4 million on an early stage. And actually in this deal I was looking at, it was 3.5 million was the cap. And then the person, you usually do either one or the other of these. If you have both, then you just pick the one that's the best for the investor. Okay, and then there's a whole bunch of other stuff that goes into the deal beyond the valuation. So everyone gets very caught up in the valuation, but price is actually only one factor. So even if you get a great valuation, you may have terrible terms. So here are some terms. I am not going to go in depth to them, but liquidation preference, who's on the board of directors, anti-dilution clauses, protective provisions. Convertible notes and safes are actually debt, which means if the company goes bankrupt, those people get paid first before the equity holders. So there's some stuff that can happen if you get into trouble. There's also something called participating preferred. I'm not going to go through any of that tonight, but Brad Feld has a term sheet series online that is excellent, that goes through all of this and more. So I highly recommend sitting down with a nice cold beer and just reading about deal terms for hours. Okay. So what happened with us, we talked in the beginning about valuations and how you get there, and there were some easy formulas and some complicated formulas. So what actually happened with us was we had some traction, and we started shopping around to VCs, and we also got a strategic investor interested. A strategic is a big company that might have a venture arm that invests in startups. So we actually had a couple deals on the table, a couple offers on the table at the same time. And we finally ended up going with one of the VCs. We decided not to take the strategic money because they wanted a seat on our board of directors, which meant they could kind of steer us a little bit. And we didn't want to limit, they would probably have steered us away from their working with their competitors, and we didn't want that kind of limit at the beginning. And we were in the fortunate position of having the choice of going with some other VCs. And the VCs we were going with, we were raising $2 million and they wanted to own a third of the company. So then if an investor wants to own a third of the company, and in this example, they're putting up 100K, you can actually solve for the pre-money valuation using only that information. So you don't need to know what the company's worth or estimate, you just solve for it. And the way you solve for it, so remember the way we calculate the investor ownership, it's the cash invested divided by the post-money valuation that gives you that 33 1/3. So taking that, we can use this formula, which is cash invested divided by percent ownership is equal to the post-money valuation. And so in this example, your 200K divided by 33 1/3% gives you a post-money valuation of 600K. And then, who wants to tell me what the pre-money valuation is? Anyone? 400. Yes. So you just subtract out the cash invested from the post-money to get to the pre-money. So you can solve it this way, and this saved a lot of time because we didn't have to do a whole lot of wrangling. So they made us an offer. We were raising $2 million, and they made an offer of $4 million, which is essentially the same math. And we came back and said, look, we want the pre-money to be $5 million. We negotiated some other terms, but they came back and said, okay. So we raised two on 5, which is raising $2 million on a $5 million pre, which gave us a $7 million post. So their $2 million of that $7 million was 28.5%, more or less. So we saved 5 percentage points by going back and asking for that extra $1 million in pre-money valuation. Okay. And then, as I said, people prove me wrong all the time. So you get the deal you negotiate. It's about sales. It's about negotiation. It's about having some traction or some leverage. And of course, you get the best terms when you don't need the money. So, a lot of times entrepreneurs are doing great. They won't raise money. And then all of a sudden something goes wrong and they need the money. And it's much harder to raise the money at that point. So you kind of got to balance. It's a little bit risky. And I actually have one entrepreneur that was doing great and wasn't raising money, and then wasn't doing as great and started raising money, and then started doing great again and just told all the investors to go away. So that works too. Although I would say if they really want to grow, at some point when they have their engine working, if they want to exit and grow quickly, they should probably raise some money, but on their terms, not because they need to do it. So how do you get the best deal? You have some traction. So the investors really want to work with you because you're doing something great. You know that's happening when investors start contacting you, or it gets easier to get them to answer your emails or take your phone calls. Having multiple offers like we did, we had offers from 2 VCs and 1 strategic. So that gave us 3 parties that we could sort of go back and forth and play things off of. And the same thing happened when the company was acquired. There were multiple bidders for the company. So they were able to do the same thing. And then there's other stuff like having a Rockstar Team. You see people who've previously done something are able to raise all kinds of money. Although sometimes I would argue having too much money is worse. Like if you skip the ladder, you get yourself into trouble even if you've been successful before, often. If you have some personal connection, people raise from friends and family all the time. And then making sure you're talking to the right investors. So every investor has a thesis. They invest in certain industries, they invest in certain types of companies, they invest at certain stages. So you get the best deals if you talk to the investors who invest in the space you're in at your stage. In Miami, a lot of people end up talking to real estate people, and real estate people don't know how to invest in tech. And so the terms are terrible because the real estate people are looking for a sure thing, and tech is not a sure thing at all. So there's a lot of factors that go into that. And then geography. So in Silicon Valley, things tend to be a little more startup friendly, and in other markets, they tend to be a little bit more investor friendly, and that changes. And sometimes there are bubbles. Like there's all kinds of factors They go into getting the best deal. And then the gotcha is there's something called an option pool. And so what an option pool is, if you raise real money, the investors want you to hire great people. And so the option pool is equity that you're using to hire and retain great people. And you would put them on a vesting schedule. So, you promise them a certain amount of equity if they stay for 3 or 4 years, and then the equity would vest over that time. Forgot to turn off my ringer. And so typically you'd be looking at 10 to 20% of the equity would be carved out as an option pool. So your company has 100% equity. And a lot of people get confused about the option pool. They think it's about retaining control and they get really nervous. But really it's about hiring great talent and retaining that talent. So just to walk through a little bit of easy math. So if you're selling 20 to 30% of your company to your investors, on top of that, you might have another 20% to the option pool. So it could be, half the equity is being used, 30% for the investors and 20% for the option pool. And our deal at SideRock was sort of in that, it was a little less than that, but it was sort of in that neighborhood. So that's expensive in terms of equity. But tip number 10, you want to use equity to attract and retain the best talent. And so if everyone has a low percent ownership, that basically encourages people to stay for a while and then leave. So you're self-selecting for mediocrity. And Vinod Khosla, the founder of Sun, can say this better than I can, so I'll let him talk.
Today, we have Vinod Khosla, founder of Khosla Ventures and former founder of Sun Microsystems. He has advised a lot of startups in Silicon Valley. I'm going to interview Vinod today, and we're going to talk about how to build and manage teams. I wanted to touch upon founders' equity because I know you brought that up twice. So how should, especially when you're trying to attract, you want to build a great team, right? And a great team is a magnet for other, people to join the company. How should founders think about equity, especially in the early hires?
Yeah. So I find, by and large, and there are exceptions, plenty of them, founders keep too much equity for themselves. And they don't realize the following fact. Anybody they hire who's exceptional will a year later figure out they want to start their own company unless they're a founder. Right? So if somebody is really, so you self-select for okay people, good people, not awesome people. So my son's starting a company, actually 2 companies right now. He graduated last June from Stanford. And I convinced him that him and his co-founder should just take 15% each, leave 15% for a third founder, and another 15% for 3 junior founders. And then a 20% pool after that. So they have this humongous pool. I said, because I fundamentally believe a company becomes the people it hires. I said, you'll be able to hire great people. So for one of his companies, and I think this is public, if it's not, stop recording. He just hired for one of his companies the VP of engineering of Quora. Why would that person join a fresh graduate? Because 1, he helped define a fairly interesting large vision, but 2, he had this huge pool. And he's been talking to people who would take that kind of thing, any of whom could start their own company. Let me invert it and say, when a team comes in to present to me, one of the questions I ask myself in judging how good a team is, do they have expertise in all the areas they need expertise? But the single most important question I ask, on this team, if some of these people left and started a company, would I want to invest in that company? If somebody has 2 people like that on their team, 0 chance I won't want to invest. Independent of whether I like the plan or not, because they're collecting great talent. If I could have great talent or a great plan, I'd rather have great talent and somebody, a founder who loves great talent. But I really religiously believe this idea. You get a Bill Joy or Andy Bechter, and they weren't experienced, they were graduates, but they made the whole company. Eric Schmidt wanted to come work for them. By the time we had first 10 people, we were getting so many resumes. Everybody wanted to join us because we had so many awesome people. Other than I was sort of, me and McNeely were just fresh business school graduates. We didn't count. I always say, and I keep telling my son, hire some magnets. The people, I tell them, you graduate from Stanford, you're young, nobody's going to come join you just to work with you. Right? Think about who you could get that everybody wants to work with. That's how you'll hire the numbers 10 through 30 or 50. A rough rule of thumb I use on equity, I think Sam has said at least 10% of the company should be reserved for the first 10 hires. I actually think that number is too low. I flip it around and say when a company is 50, the founders should have a third of the common. Their direct reports should have, so if there's 5 or 6 direct reports, should have a third of the common. And everybody else, the engineers, the worker bees should have a third of the common. If you do that, people don't leave. But the single biggest reason people stick with a company is because they have people around them who are really awesome that they can learn from, who are better than them. Everybody should feel that way. So great missions, great people to work with, all that is why you want people in your team.
A company becomes the people it hires. And so hire some magnets. And to do that, this is the formula he laid out, 15% for each of 3 founders, 5% for each of 3 junior founders, 20% option pool. And investors like it when there's more than one founder. You run into someone might get hit by a bus problem if there's just one founder. And usually founders have complementary skill sets, so it's actually good for the company if there's multiple people involved. And then again, you want to put people on a vesting schedule. There's also a great ebook on Amazon called Slicing Pie that is all about how you can adjust people's equity based on their contribution. One of the problems that people fall into is, so you carve out this giant slice of equity for someone, and then they come on board and they don't do any work. And so if they're on a vesting schedule, you can delay giving them equity, but your only real option is to renegotiate or to fire them if you want to preserve the equity. He's got a formula that you can use to adjust based on how much people actually contribute once you get into the weeds. Because people saying they'll do something versus actually doing something is often very different. No one in this room, of course. Okay, and one more thing. The secret to successfully raising money is, drumroll, build a great company. And that makes everything easier, right? When you really have a working business that people are excited about, they want to work with you, they want to invest with you.